Good morning. Welcome to The Brew. I'm Lex, your host. Today we have the Traders Workshop with Jason and Mark, and we are going to talk about volatility ahead, VIX options, and the pre-election pricing anomalies. So let's get right to it after the bell. See that? Music is what color sounds like. Just saying, it was apt today.
Was that a musician or an artist that said that?
It was the Life is Good people who said that.
Yeah, I was about to say it was Lex's shroom dealer that said that.
Do you know shrooms? I read an article about shrooms. It's supposed to do something for you. I think it's supposed to help with dementia.
Yeah, I've heard that actually.
Dementia, lots of like mental illnesses too, addiction. Oh. It's huge. All those
right. So I'm fighting through my dementia right now, and I'm remembering what it was. So the people who were doing shrooms, they were having godlike experiences, in the shroom state, and they felt like they were
what godlike experiences
like.
Like.
They felt like they were talking to God. They were giving a bunch of atheists, I guess. I don't know. Who knows? All right, let's get going. What's up, guys? How are you? VIX is the topic. I have a couple questions, by the way. We will get to those in a second as they pop up. So this came about because Jason said that through your model in vol.land that you saw a little pricing anomaly in October VIX futures versus November. I think it was. Is that right?
Well, I mean, I just suggested. I suggested that as a topic because you see it all over Twitter and in some articles and stuff that VX futures right now have are a lot higher than the November futures than November VIX futures, right?
Right.
So and then I read somebody's tweet saying, why is October futures so much higher when the election is in November, right? And I think it was just, I mean, it's like a 3-minute show if all we say is it's because VX futures are reading the VIX. The VIX is 30 days out. Therefore, October, 30 days minus election would be the October expiration. So, okay, show's done. We can go home, right?
Okay. I get what you're saying, but I don't think everyone got that.
Right. And not just that, but I think it's
structure detail, right? Like it's anyone that wants to trade vol or a vol product, like you have to understand the quirks of like what you're trading, what the underlying is, and what it's settling against.
Correct.
Yeah. So I think it's a good idea too we've got 26 minutes left. We can go through all these vol products and tell people, what exactly are you trading? And then even vol products that people can't trade, like variance swaps and stuff like that. So I don't know. I thought it'd be a good topic since I saw some misinformation out there.
You saw some misinformation out there. Okay, so what do you do with this? So is there anything to do with this? I mean, is there a trade that we can set up or not really?
Well, I think it's preventing people from making a mistake. Thinking that they can sell October vol, thinking that VIX will come down since it's not the actual election. It's not like it's not a anomaly. It's the way it is supposed to be because it is exercising on the VIX, the VIX index, which is looking 30 days in advance. So October is the appropriate election VX future bump.
But to be clear, you won't be trading the results of the election. You're
right.
That the VIX future that expires on October 19th, something like that, 17th, that is going to settle to the value of the VIX. That futures settlement value is what the VIX will be on that day, on October 17th. And the VIX on October 17th, the VIX is an index. The VIX is an index that looks at a strip of SPX options that are 30 days in the future. So on October 17th, the VIX 30 days in the future is going to be relatively high because 2 weeks into that expiration period is a seminal event for democracy, and so the VIX future will settle to that future event, even though you don't know what's going to happen.
Mm-hmm.
Right. So when you trade those October futures, what you're trading is actually what the VIX going higher or lower in that time frame.
But looking 30 days out, which covers the election, is what Mark was saying.
Yes.
Right. Okay.
The other funny thing too, it's that we could get this out of the way now. When is election day? November 4th or something like that?
Yeah, something like that.
So when October 4th hits and VIX shoots up, do not be surprised, because that means that the implied volatility of election day is right there. And now that we have daily options, which we didn't have in the last election cycle, you're going to get it right.
That's right. Interesting. Okay, so there's really the crux of it, though, is there's really not a glaring opportunity here. It's priced probably how it should be.
Yes.
Relative to some uncertainty as to who's going to be the next.
Well, it's
the market's pricing that there will be about this much election vol in the VIX 30 days out.
Yeah.
And that maybe that's more than expected election vol. Maybe it's less than the expected election vol.
Yeah.
But the actual election vol is a second question that's independent. That whether the VIX on October 15th actually accurately prices what the realized vol will be over the course of that election period.
I was actually going to ask you guys that. Do you have an opinion on, is it too high, too low, or just right? Do you have any feeling on that, or not really? Hard to tell.
No.
There are so many more billions of dollars than I have that is putting it at this level, so I got to say it's fair.
Yeah.
Yeah, I have no opinion. I mean, I don't even actually think that whether Harris or Trump get elected, I don't think that matters as much to market. They're both policies are very inflationary. It's going to be this, both of their economic policies are using the same kind of tools to, just in different places.
Yeah.
Mm-hmm. But that being said, I mean, I guess the point I was going to was we should probably, list what is the VIX, then what are VX options or VIX options, what are VX futures, what are, we're about to see VX future options, which confounds me. And then we have you hear about variance swaps, and you hear about I don't know, there's other swaps too, volatility swaps, right? There's so many things, and then you have all these ETFs that are based on all these things. And I kind of get the idea that there's people out there that do not understand all these products and don't understand why I wouldn't trade them ever.
Oh, great. Now we just make a statement about not trading a product. Wonderful.
Well, it's not yours, so
Do you know what
was futures options? We should bash them all day. Come to Tradier and trade VIX.
There you go.
Yeah.
We used to trade VXX, which was utterly just a decaying product. It was built to go down, if you remember how it was structured. So it was another product I just couldn't stand. And then there's Vixen and there's triples, and oh my God, yeah, you're right.
The decay on that is ridiculous. You're just paying Contango all day.
You're paying Contango all day. That's right. Which means that
every day.
The way that the VIX VXX product was structured, I think, is every day the front rolls off and you buy something in the back, right?
Yep.
So
the people that was good for were the SIBO, Barclays, and futures market makers. They knew someone was coming in and buying that spread every day.
Yeah. So you said Contango. Let's explain it. Can you explain it, Mark, what that means? Because I know some of the viewers are going to be like, what the hell does Contango mean? And then I'm going to throw backwardation in there as well. So while you're at it, why don't you pick either side here, if you can explain it in a sentence or two. What does Contango mean?
What we're describing here is the shape of the term structure. And so the term structure is a given value over at different expirations or different points in time. So usually it's like with the futures or at the money vol or something like that you'd say, what is the November future? What is the December future? What is that January at the money vol, et cetera. And so the shape of that curve over time, Contango is the idea that the front month is below the back month,
right?
Back months. That back months, and typically we talk about this in like commodities and whatnot, back months tend to trade higher because there's some like storage cost to that, good over time. And so like naturally there's, a contango. It's not particularly steep, but front and spot tend to be below.
Right. So, but that's common though, right? To have contango in the marketplace. Is that fair?
Contango is the natural default equilibrium state.
Okay. And how about backward? Go ahead. Sorry. Go ahead. Keep going.
I'll talk about backwardation. Ready?
Okay.
It's the opposite of what he said. All right. Thank you.
It's backwards.
So near-term volatility is higher. Just to see where that is normal. You see it a lot in, say like winter months in natural gas. You'll see it in the 0 DTE options on equities tend to be higher implied volatility than 1 DTE.
Right.
Even like the week, like, for the week, it kind of backwardizes and then, goes, becomes contango about a week out in equities. I think metals sometimes like when there's like warring or, something like that, when there's backwardation in the equities market, typically what that's saying is that there's a short-term liquidity problem or a short-term, that instability in the market. But if that instability becomes stable, then that implied volatility comes down really fast. And, dealer hedging and everybody's positioning all changes really swiftly. So, let's have a look at the remarkable. Can you guys bring that up for me? Oh my God, I drew this real quick. Look at that. Isn't that beautiful?
Frame this. Put this on the wall.
Put this on the wall. So all this means, this graph, this is Contango, the top one, right? So this is near-term data right here, right? And we're going out in time.
You got to label your axes.
Yeah, I know. This is out in time here, but and it could be the date, right? So, and then this is the value of the future. It's up or implied volatility for that matter. Either way, this is typical Contango, and conceptually why it exists like this is when volatility sort of stayed, meaning nothing's really going on. You're pricing in a little bit of uncertainty as time goes on because it's time. You don't know what happens over time. When you get shock waves, right, in the market right now, you tend to have this thing start sickling up. So this thing starts moving up. And this long-term implied volatility tends to be around some long-term historical mean-ish, right? It's going to fly. It's going to float a little bit back there, but it's going to be much more muted because there's so much time to buy, right? So it'll go up for sure in these kind of environments, but it's kind of like the sickle, right? It's like, that back doesn't move as much, but the front flops around. So we tend to see this sort of backwardation. We have a lot of near-term implied volatility. We probably had this, in 08? I'm not sure Jason was born in 08. Were you born in 08? Yeah.
I was in diapers.
You were in diapers.
But actually, though,
it's a great example. And like Jason was saying about like liquidity events and like short-term, like I think you can look at this through the lens of like investor psychology too, right? Like investors tend to have like a very short-term focus and they panic in the short term, and that creates this backwardation where all we can see is all this disaster that's happening in front of us.
Right.
Global wars, famine, whatever is causing the panic right now. The carry trade blowing up. Like, I don't think that put us in backwardation, but actually maybe it did. But like anyway, like when your lens is only the first 30 days, or that's where our like focus tends to be, I should say, is these first 30 days, you're going to panic at this, that, or the other thing. On the flip side, you're also going to say, things are fine right now. Things are going to go great for the next 30 days. But I know in the future there is something that could happen.
Correct.
You give me enough turns and something's going to happen, but that's probably not in the next 30 days. That's the way we tend to operate most of the time, except when we're panicking and we go into that backwardation.
Yeah, it's like when you go to like an interview or something and they say, what do you want? What do you see yourself in 6 months? and you're like, maybe working here or whatever. And then they're like, where do you see yourself in 5 years? I don't know. That's 5 years. It's like, that's like, 10%, it's almost, it's a little on 10% of my life, and it's about 2% of Lex's. So, I mean, like, we have to, we have to like, and 5 years. So I kind of see the long term, the long end of that contango, like that January, February,
out here,
as more of a investor sentiment on what they think about the market. Because, out there, it typically tends to be like 20, 21 implied vol, right? If it's up at 26, that means there's people that are kind of scared about what's going to happen over the next, 6 months, 7 months, 8 months.
8 months of 26 implied vol is a lot of movement.
That's right.
That doesn't sound like that much higher of a number, but like when you compound that much higher of a number every day for 8 months, that's a lot of panic.
Right. That's for sure. All right. Another point I want to make here too, important. I label these months, right? So the way VIX works is each one of these months has its own future, right? So they trade independently, and interestingly, they are not fungible, which means that they don't cancel each other out. If you get assigned and take delivery of a future, or you exercise and take delivery of a future, they don't cross each other. November and Oct don't cross each other out. They exist. So interestingly, and we can go back to we don't have to share the screen anymore. We can interestingly at retail brokerage firms in VIX, they will not allow you to do calendar spreads in VIX because of this interesting concept with futures. What do you guys think about that?
Well, first, I think we should be clear that a VIX option exercises to a VX future. Okay. So the underlying is like that. And you're right. And this goes for all future markets. Each time, each expiration of a future is its own separate, you can almost say its own separate underlying. It'd be similar to just two different stocks.
That's right.
As far as calculating,
they don't settle into the future, they settle on the future, and they settle in cash.
Yeah, that's correct. Yeah. That's a good point. That's
right. They settle in cash, which is the difference between VX options and these future, these soon to be released VX future options, which is they're gonna settle as the future. VX options are settle as cash.
Why do it then? And if they settle in cash, why the hell do I care about a time spread all of a sudden?
Well, because the two underlyings are different.
Exactly.
If you have an October,
but I'm settling in cash, which is all fungible. So
if you have a calendar and you get exercised on the front, or let's say the call were to go up, or the October VX future can change without the November VX future changing. So because of that, then they will, you can lose a lot more money than what implies by a calendar spread. Since it's not
okay, that makes more sense. Okay,
if you have the calendar on, going even if you're a long calendar going into November, October or something.
Yeah. So the point there then, just for clarity, then is because of that concept that your calendar you pay $1 for, just making it up. It technically in listed world of equities, you could lose $1. That's your max loss, very definable for the clearing firm to margin. However, with this product, because even though it expires in cash, your future prices can be way beyond that $1. It can be negative the other way or positive massively, depending on how that settles. And the fungibility means that, we don't know if you pay $1 for a calendar in VIX where it could be way worse than $1, right? Your loss. So that is truly the issue here. I don't know a lot of retail brokers who allow those calendars to exist. I'm assuming not many, if any, allow that at all, which makes sense.
You have to have a portfolio margin dynamic for that, right?
Yeah.
Where you can shock everything and charge margin off that.
Yep, I agree with that. Interesting. So I had that question posed to me yesterday, as a matter of fact, about why we can't do calendars in VIX. So there's your answer. Okay, Apollo. Jason, do you know Apollo from your?
Yeah. What did he say?
Apollo says, I would love for Jason to go on and ramble about variance swaps.
I don't know if that we got 3 minutes left.
Yeah. Go ahead. Ramble for 3 minutes if you want.
Ramble for 3 minutes. Variance swaps are an institutional product that it measures the realized volatility for 30 days, or I guess from the time you buy it prior, right? So it's a 30-day. If you buy a 30-day variance swap, what you're saying is that the realized volatility will be more than what that variance swap is pricing. VIX is what prices that variance swap.
Okay.
How's that? Is that good? I'm trying to not ramble because I don't want to ramble about how frustrating it is that it's only an institutional product and you can't trade it. So
don't bother.
You want to sell uncapped variance?
Yeah.
Are you looking at managing a pension fund anytime soon?
Yeah, I mean, a lot of those pension funds sell them like crazy because, you know, most of the time implied volatility overprices the realized volatility. And so, you know, when you're not pricing VIX, you know, like the VX futures are, or, you know, when you're not pricing the actual VIX and you're pricing what VIX is trying to predict, you know, you have that realized volatility, implied volatility gap. And typically because of that contango, you make money on those variance swaps a little bit, you know. But if you lose money on those variance swaps, you lose a lot, you know, like if you were subject to that Japanese spike, you know, the Japanese yen spike thing, whatever.
Look at SVXY. SVXY but is similar to that dynamic, right? Where you're making a little bit of contango every day because you're rolling your short and positive carry based on that. But when it explodes the other way.
Yeah.
And it doesn't make it back the way like SPY would or whatever, like when the market
and it's squared returns too. So
yeah, exactly. Geometric kill.
It makes it worse. It's exponential on exponential, which I guess is why they don't let retail trade it. But
do you guys back to VIX a little bit. Did you Mark, when you were on the floor and trading back in those days, you traded VIX at all or no?
Oh, Group 1 was the original DPM in the VIX.
Yeah, that's right. But you didn't do it yourself, right?
Me personally, no, I never traded because we had the godfather of the VIX in there. Are
they still specialists there, Group 1?
No, they removed the DPM designation in like 2017 or 18 because basically there was a firm, which shall not be named, which was taking advantage of the customer priority rules and had a very liberal interpretation of orders per day for customer accounts, and were essentially making markets. And it blew it out such that like it screwed over the DPM, but it screws over all the other market makers because you have customers sitting at the top of the book in every scenario. So
I wonder
they removed customer priority in the VIX, and with that, obviously, has to go to the DPM.
Yeah, I wonder who that was. That firm, that unnamed. Okay, never mind. I won't say it. I wonder. Yeah, we didn't trade VIX either. I mean, we didn't trade. I didn't trade VIX. Our firm really didn't trade VIX much at all, either.
Which firm did you work for, Lex?
My firm.
Oh,
yeah,
the Lex firm.
No, it's Boda. We were DPMs in equity options, not in very, very little presence in the indices. So, and there were firms back then at SIBO and all the exchanges that were flipped the other way. There are very much index specific firms like Hull Trading.
It's
very massive in the indices and didn't touch equities, right? So and some firms like Susquehanna, they were involved in everything, pretty much. You guys probably were
much
too,
bigger
right?
multi-list than they are index.
Say again?
They're much bigger multi-list than they are index. Like their multi-listed product business, I think, is significantly bigger.
Right.
I mean, you have firms in the index pits that no one in the equities business has heard of.
That's right. Yeah, it was funny because when I was down, when we were DPMs on SIBO, Tom Sosnoff of Thinkorswim and Tasty Works now, he was an index guy. He was an OEX guy. So we knew each other by face, but really didn't know each other very well because I never saw him in any of our pits, in our equity pits, unless there was a takeover, right? So whenever there's a takeover in a pit, like Chrysler was a big one. That was one of ours. That was a huge one. So you see all these index guys when they're bored, they come over and clump into where all the volume is, and then you see the index guys. But they all hung together. Those index guys, they were a very tight group. So, yeah.
Finance is a very specialized thing. Like, not even just you trade options. Do you trade equity options or do you trade index options? Do you trade tax-settled index options or do you trade futures options?
That's right.
I mean, there really are different clans.
No, I agree. It was fun though. All right, guys, we should probably run. Good chat. Good to see you guys as always. Next Thursday, I'm not even sure what our topic's going to be yet. It's too early. We're going to come up with another variant.
Contact us on Tuesday. It's too early.
True. Good point. The market's dynamic. Things are moving. I've got to go bail myself out of this horror story I have with NVIDIA and CRM. I got a double loser going on right now. Jesus. It's supposed to move. Don't worry. We'll get there by the end of the day.
Okay. That's what you got to keep telling yourself, right?
Right?
You still got till tomorrow.
Oh, that's right. I forgot about that. Yeah.
I mean, I know you don't work on Fridays, but the market is open on Fridays.
Wait. There's the market's open on Fridays?
Yeah, every Friday.
Heck?
Except Good Friday.
It's a golf day. My God. All right, guys. Have a good weekend and
happy trading.
Happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.